Hey there, this is George. Welcome to the channel again. In the last video, I talked about how to set long-term goals. If you want to learn more about this, just go ahead and check it out. But in this video, I'm going to talk about how do I evaluate companies before investing in them and what factors you should consider before doing it. Right now, my asset allocation is more focused on technology, either companies with high market cap, ETFs, cryptocurrencies, but I'm also investing in companies with a smaller market capitalization in which I need to do a deeper investigation. Evaluating a company is always important, but especially right now, considering the current phase in which we are in the economic cycle and the overall economic situation. Low economic growth, high interest rates to combat the tremendous inflation, and low consumer confidence. The first thing that you should ask yourself before investing in a company is, do you like the business model and value proposition? Is this business convincing stakeholders that its products are worthwhile and different from with respect to its competitors? Another thing to consider is if the company is operating in a growing market or industry. And what about international markets? Is this company operating in another country? An example of a declining industry is the railroad industry, which has experienced decreased demand in the last year due to newer and faster means of transporting goods. Primarily air transport and trucking that has failed to remain competitive in pricing, at least in relation to the benefits of faster and more efficient transportation. Maybe if you're trading, this is not as important, but if you're value investing and pretending to achieve asset appreciation in the long term, you should probably search for this. Another thing that not many people think about is if they like the products of the companies that they are investing in, and in fact, are you using them? Because when you have them, you can see their development and therefore their strengths and weaknesses. For example, I'm investing in HP because I've been using their laptops since I was young, and honestly, I've never had any problem with them. So, I like the products, and after doing all the steps that I'm going to mention in this video, I really trust the company and their future performance. Another thing to investigate as well is your company's market share and see if they are operating in a new market or, on the other hand, in an existing market, because this may affect the supply and demand of their products. I usually invest in the leaders of new but growing markets. You should also do a brief analysis of the competitors to see what they are doing different, and because maybe you like them more. This happened to me last year that I was going to invest in a company called Blink Charging Company. This company was producing chargers for electric vehicles, but then analyzing the competitors, I saw another company that was called ChargePoint that had better numbers. They were managing better their resources. I saw also their financial statements that were better, and they had better higher market share, and I ended up investing in this one rather than in the previous one. Then another thing that I like to see is if they have a good branding. This is maybe more for companies that have a small market capitalization and that are less known, but it's important that they have a good brand awareness, brand loyalty, brand recognition, or brand image, because this will affect their future performance. After doing this research and building a little bit my own opinion upon this company, I also like to listen to other investors or searching on Google for more information, because these people may know more about this company than you, and sometimes this is useful. I'm not saying that you should just listen to these guys and do what they say, but sometimes this is useful to gather more information. After reviewing all of the things that I said, now I do one of the most important things, that is evaluating the financial statements, the income statement, the balance sheet, and the cash flow statement. I will probably discuss the parts and sections that I observe in the financial statements in another video, because if I do this right now, this could take forever. One of the things that investors look at before investing is the ratios. You can see some of them in Yahoo Finance, in your online broker, or in any other website that you like, or even by calculating them. I'm going to explain some of the ones that I believe that are the most important ones. The first one, and I'm sure that most of you have heard of it, is the PE ratio. This one indicates whether a stock at its current market price is cheap or expensive. This one is good to analyze companies in the same market or industry. The second one, the beta value, is a concept that measures the expected move in a stock relative to the movements in the overall market. A beta greater than 1 suggests that a stock is more volatile than the broader market. However, a beta lower than 1 suggests that a stock is less volatile than the market. Let's imagine that the running shoe market has fallen by 6% during the recession. If the beta value of a company in this market is greater than 1, it means that the value of the company will most likely decrease more than 6%. Two other ratios that I like to look at are the dividend yield and the payout ratio, that is, the percentage that a company allocates of its profits to the distribution of dividends. Many publicly traded companies don't pay dividends, but some of them do, and this is always a good source of income for the people that are long-term investing. However, I don't usually invest in companies that pay massive amounts of dividends, like 7 or 8%. I think this is too much, but the ones that pay at 3-4%, I think that are secure. A healthy current ratio is normally between 1.2 and 2. A current ratio of 2 means that the company has 2 times more current assets than liabilities to cover its debts. A current ratio below 1 means that the company doesn't have enough liquid assets to cover its short-term liabilities. Another ratio that I love is the inventory turnover. The greater means that the company has strong sales. An appropriate value is normally between 5 and 10. And then last but not least is the net profit margin. Let's say that the company has 60% of net profit margin. This means that for every dollar sold, the company is making in net profit 60 cents. Then the last part of this video is the management discussion and analysis. I think that reviewing this section is very important, especially if you're in long-term investing. In this section, executives review and analyze the company's performance. It can also include a discussion of compliance, risks, future plans such as goals and new projects. As you guys can see here, this is the MD&A of Blink Charging Company, which is a company that produces chargers for electric vehicles. Here you have an overview, which is a brief description of what the company is doing in this market. Then recent developments. It seems that there was an acquisition last year of another company, and other useful information that may help you to decide whether you should invest in this company or not. Look, we see here that there's a note on COVID-19 and current economic conditions, how COVID is affecting the operations of this company, and key factors affecting operating results. Well, this is all that I have for you guys today. I hope you liked the video and that you learned how to evaluate a company. Remember that we have to take advantage of this year's recession because the prices are fairly cheap, and start building our wealth for the future. See you in the next video.